But we all know what we're dealing with, the sleazy little people that run the corporate news, and who they're beholden to.
Ron Paul will be in Vegas first week in July.
I'm going to be out there as well.
For that shindig at Bally's?
Yep.
Darn, just like I need an excuse to go to Vegas.
Well, if you do, I'm going to make you give you your wallet before you walk in. Yeah.
What wallet?
Yeah. Mr. Moneybag. No, it's a big money belt. You think he's fat? No, that's his money belt around his waist from all that money made out of his stocks.
Yeah.
Hey, one thing I wanted to do here real quick.
I took it all back yesterday.
John Rogue, and this is how desperate they're getting. Not only green shoots propaganda coming out of the White House, of course we know what the Bloomberg and the cheerleaders for Wall Street are doing, but I want you guys to hear what John Rogue from WJB Capital Group had to say on the issue of gold. And Bob, I wanted you to specifically hear this because what a load of hudda this one is. Check this out.
Chief Technical Strategist at WJB Capital has been a gold bull for quite some time, but gold's failure to break through a key resistance level has him thinking differently in the near term. He says if history's any guide, prices could slip back below $800. John Roque is here in studio, and John, we thank you for your time this morning, as always. So, technically, what's been happening with gold that makes you a little cautious in the near term?
Well, if you and I had done sort of a Rip Van Winkle about a year ago, and we had awoken quite recently, and someone had told us that Lehman was gone, and Bear Stearns was gone, and AIG and Fannie and Freddie had tremendous problems, and Citigroup had gone down 95%, and the financial system, as we knew it, was on the cusp of collapse. We might have high-fived and said gold, $1,500.
Right.
But it wasn't higher than it was a year ago. So we started to get a little bit more critical of gold's performance. Why couldn't it break out if we had the, semblance of financial Armageddon, number one? And number two is there's been a lot of talk recently about inflation and how inflation is going to be the next bugaboo. Well, if it's going to be if there's going to be an inflationary period, then we think gold should also be doing better, yet it's not. So we're starting to look at gold a little bit more critically, although we've been a fan for a very long time.
And something you have been tracking is gold versus the 30-year, technically speaking?
Correct.
Tell us how this works, why this is worth taking a look at.
Well, we created a very simple ratio. We divided the price of gold by the price of the 30-year Treasury bond. And conceivably, when gold outperforms the price of the Treasury bond, we've called it inflation. It might be a misnomer, but that's what we refer to it as. And when the price of the 30-year Treasury bond outperforms gold, we've called that deflation. Again, it might be a misnomer, but it's easy for us to represent it in that fashion. And gold versus the Treasury bond, if you create that ratio, is up into a resistance level, as you can see on this chart. And the momentum that has taken it to that resistance level is starting to weaken or flag. And so we're a little cautious here as to whether or not gold is going to be able to rally further, which we don't think it's going to right here. And we think the Treasury bond, because it's gone down pretty consistently since November, December, is worth a shot on the long side.
Right. And technically speaking, is that the key chart you're watching for that idea of gold maybe going below 800, or are there other technical indicators that you're watching?
Principally, this is the indicator, because as this particular chart has risen to this resistance level, this is the, let's call it the third instance that the momentum indicator has gotten this overbought. The corrective phases for gold post this signal have been pretty sharp, so we want to alert our clients to that notion.
Speaking of gold, or maybe something golden, a lot of people have been talking about golden cross, or the golden cross trend that we've been seeing. We saw it with gold a while ago, just when the 50-day moving average moves above the 200-day moving average. Now you're starting to see a number of equity indexes.
All right. Bottom line on this, well, they'd like gold, but what they would like their clients to do is to buy 30-year treasuries. Now, try this one on for size. Bob, what's the yield on a 30-year treasury right now?
I don't know. I'd have to look. I only follow the 10 and the 2 closely.
All right. Well, what's the 10?
We get a 369 on the 10. Wait a minute. Here's the close. 365 down from 4.01. And I would think that the 30 would be about 385.
Okay, so just say, well, let's be nice. Let's call it 4. So they want people to move into 30-year treasuries paying an interest or a dividend of, say, 4% on that 30-year, when inflation is running at what percent right now, but yet hyperinflation hasn't really hit yet. They're trying desperately to suck in all the excess money, or the money, the cautious money out there, so they can take it away. Yeah, so the story is out there, green shoots for everybody. Don't worry about it. It's like wheatgrass, and we'll all sing cool.
Yeah, but you got to understand something about that statement, because it's a statement that not only he's made, but every other leading financial advisor out there all repeats the same claptrap. Gary Schilling did it this morning on CNBC, that we face financial Armageddon and gold failed to go to $1,500, $2,000. These people don't take into consideration that there's a good reason why gold didn't go to $1,500 and $2,000 is because its price is manipulated.
Exactly.
So they use that as, and I'm hearing that more and more often of late.
Well, and the indicator is that if it was such a hot deal, people would be buying it, which would be pushing the price up even higher. But the signal they're trying to give is, well, that used to be an okay investment if you weren't quite sure, but everything is okay now. Now you can go back into the bond and treasury market. Everything is just fine. Robbie, are you going to buy treasuries and bonds? Bob, are you going to buy treasuries and bonds?
No, I don't think so.
I don't think so either.
Well, I have some comments to make out of. First of all, it's the old story. If the dog had not stopped in the middle of the road to go to the bathroom, he wouldn't have gotten run over by the truck. And these people play with charts. On a short-term basis, because the markets are manipulated, all of them, charts don't work. On a long-term basis, they do, to an extent. It all depends on what you're working on and how much manipulation in that particular market or currency or stock that's going on. Usually, when brokerage firms or brokers come up with these kinds of solutions, they're usually trying to churn counts. They want to make commissions, usually.
Well, sure.
And to do a ratio with a 30-year bond and gold is true, purely idiocity. These people are making up excuses to make a trade. That's what they're doing. Whatever the motivation is, whether the government asked them to, or whether they get a friend in government and said that would be good, or whether they want to churn for commissions, justify their existence as money advisors. There could be a whole bunch of things.
Yeah, they got a name for them, Bob. They call them the bond vigilantes.
Well, and it's, if you've been listening to the rhetoric, and we haven't even rolled around to the abomination and the great plan. Now, isn't this rather the timing? It's a little interesting that, well, tomorrow he's going to roll out with a plan to save us from the Federal Reserve. I'm sorry, so to make it easier for the Federal Reserve to save us and the rest of the planet that they've polluted, that Obama is coming out with a way here that everything is going to be safeguarded so nothing like this ever happens again. Now,
yeah, it's another Sarbanes-Oxley myth.
Well, and if you look at it, the CFTC back in 2000, thank you, Mr. Graham, and some other folks were involved in that deal where they lifted restrictions to allow the derivatives to be sold the way they were. So, you know, we've already screwed you over. We allowed this to go on. We purposely planned this for the bank bailout and to give them more control, and now we're going to fix it. And now
the Fed is going to be the boss of everything, and you know the Fed is owned by the Fed banks and Wall Street, and all they're going to do is party on. This is what it's about, and I think that Congress really is getting deluged and has been for months over this Fed issue. And I think it's going to be hard to turn the House around. How it'll work in the Senate, I don't know, but they got a good shot at the House.
Yeah, but Bob,
what is it, 225 people have co-sponsored?
Sure. Yeah.
Yeah, but, you know, well, that's another topic. But, I mean, when we look back at why did they come up with Sarbanes-Oxley? That came out because of Enron. And government was going to fix it so that another Enron never happened again and stole the life savings of millions of employees. Well, every CEO from that point had to sign off on his balance sheet to say that these figures were true and accurate. Well, how many companies have gone belly up in the last year where the CEOs signed their balance sheet saying that they had money that we now know they didn't have.
Mm-hmm.
So,
and nothing happened.
And if we look at the epicenter of the crisis, we get Fannie and Freddie, two of the most regulated industries in the United States, but yet they were the cause of it, not the unregulated hedge market. So it's, you know.